My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job's not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. After last week's dalliance with the bulls, so many strategists want to pretend that it didn't happen, that nothing mattered, nothing changed. As they see it, last week was nothing more than a short covering rally, a temporary snapback, and a bear market rally, a sucker's rally. That's what they see on a day where the Dow advances 35 points, S&P edged up 0.18%, NASDAQ gained 0.3%. Of course, I see consolidation. I dispute that bearish verdict. Although I simply can't dismiss the best week of the year, where major strides were made in broadening the rally to everything from the financials to recent e-commerce stocks to the usual semiconductor and semiconductor equipment suspects. I am not going to throw cold water on those who thought the reversal in the bond market that lowered long-term yields dramatically was just a minor incident, okay? I mean, it was big. Until last week, I was convinced the 30-year was headed for 6%. That's much harder to believe now. The guys who think it didn't matter, I'd just like to dump cold water on them. These were hard-fought victories for the bulls, people. They weren't supposed to happen. They came at a time when the stock market was oversold and the gloom was palpable. But that's true of most enormous rallies. That's how they start. The gains are now being consolidated, even as there were plenty of people who, as always, wanted to ring the register and park this money in CDs. Profits are being taken because there's been so much hardship since late July, when Fed Chief Jay Powell took the possibility of recession off the table, which meant the Fed had more leeway to keep raising interest rates. Long-term interest rates, of course, then soared. But then they stopped when Powell spoke last week, because while he wasn't as sanguine, he did seem hopeful that since we put together a couple of months of inflation trending lower, there could be more good months ahead. Instead of predicting a December-January rate hike like so many people who dismissed last week's action as aberrant, hey, maybe we should just say that the softer data continues, there'll be no more rate hikes. Of course, if any major component of inflation accelerates, including real estate prices, then I think the Fed will tighten again. Powell's not out of the equation, but the data does the talking here going forward. Just as important, the Treasury Department's decision announced last week that I harped on that no one else did, frankly, to rely on shorter-term debt for the bulk of the government's refinancing in 2024, that gave the bond bears a slim reed of hope to hang on to. See, shorting long-term bonds was a great trade, but it had gotten crowded, and crowded trades are vulnerable. It's amazing that next year's Treasury auction schedule could stop the big short in its tracks, but short sellers were growing quite wary that there might not be enough treasuries for all of them to cover without moving prices up substantially. I kept telling you we had a bond glut. But with fewer long-term bond auctions and the possibility that the Fed will stop selling its own portfolio, that glut will be gone and will be at equilibrium. And if you're short bonds, oh, my God. Now, you can frame this as a good short being spoiled, but as I see it, bulls make money, bears make money, and the pigs, well, the pigs, they would have been slaughtered. The bond bears, they'd become pigs. But it wasn't just Treasuries and the Fed. You know, I think the only number that the government issues with any staying power is the monthly non-farm payroll report on Friday. And to me, this latest one showed that the massive number of legal immigrants that have been admitted during President Biden's tenure can finally be putting some downward pressure on wages. Now, I asked Labor Secretary Julie Su about this on Friday's Squawk on the Street if the numbers came out, but she did everything she could to avoid answering the question. And I have to tell you, if I had her job, I wouldn't want to answer it either. Frankly, there's not much else to explain the softer numbers about. I mean, as there haven't been any big bankruptcies or mergers that lead to mass firings, if you're worried about inflation, you should be thrilled about more immigration, because that's the best way to beat wage inflation. But obviously, no politician's ever going to make that argument. But what matters to the market is the Labor Department's report was soft. And I think it's going to get even softer. Right now, the companies I talk to have no problems keeping people or finding people. What a change from a year ago. For most of them, it's business as usual. I see this as a sign that Jay Powell is winning his fight against wage inflation without it ever being talked about. With all this immigration, it's only going to get better for the Fed. It's incredible how dangerous it is to talk about this issue of immigration. But it's of huge significance to your stock portfolio, to the stock market in general. See, before this wave of immigration, Wall Street thought we'd be struggling with a shrinking labor force for a long, long time. Not anymore. We let people in. All that aside, something else changed last week. For a while, there was a suggestion that if you had significant exposure to China, you were finished. Apple and Starbucks gave you a 1-2 punch that showed China simply isn't falling apart. I thought Apple sales were rather strong in China. The big city share take's meaningful. Their customers seem very satisfied, which is huge since, do you remember just a few months ago? No, most people did forget. We were told the Chinese government was cracking down on iPhone buyers. That dropped the stock gigantically. I was worried about the possibility that the bear stories about China putting the hate on Apple were actually true. Fortunately, they were tall tales that meant nothing, like so much else we hear about Apple. Meanwhile, Starbucks is headed in the right direction in China to the point where it's almost embarrassing that so many people thought that they were in trouble, too. I find it astonishing how wrong the bears were on Starbucks. Yes, the Travel Trust owns both, and we are telling CNBC Investing Club members we still think that Starbucks and Apple are good stocks to own. The timing for the report from two senior growth stocks is very important. Other than Disney this week, there's really not that much left of this earnings season. If there's some retailers, sure, but if there aren't any earnings, there can't be any big disappointments on earnings. The finish of earnings season is accompanied by two things: earnest buybacks that had to be on hold until after the quarter, and an appreciation of what worked and what didn't work. Shocker, tech worked. Now we have a bit of a low here today to contend with. Will it produce fear of missing out, or will it produce more short sellers and some regular sellers? Hey, look, it's a tough question, but I think it has to be answered by the calendar. Traditionally, this is a very strong quarter for tech, and I don't think it's in the numbers. This is one of those times where you have to be ready for an Intel to pre-announce upward or an NVIDIA to crush it and then raise its earnings forecast in strong form. I did expect the fintech rally to continue, and that's faltering. Plus, the COVID-era IPOs like DoorDash and Airbnb are sagging. I didn't see that coming either. But as long as stocks like Apple don't give up the ghost, you don't need DoorDash or Airbnb to work out. You just need Apple to stay up, and that certainly was the case today. So the bottom line here, will these moves last? I think the fear of missing out will cause money managers to be less complacent about where they put their cash. I think bond short sellers may get very nervous about the fact there's no longer going to be a glut. Many of you want to buy NVIDIA, the poster boy for AI. I think you can wait for a pullback before you pull the trigger. We don't want to go against our discipline, even as this consolidation is a referendum on last week. And as I see it, it looks very good indeed. Much better than the bears think. Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Oh, Jerry, thanks for calling in. What's up?
Well, you've discussed several stocks that have been beaten down due to increasing interest rates.
Correct.
One that I'm interested in mostly has been devastated because of the needs for homeowners to finance their projects. Now that the rates seem to be at least peaking or even starting to come down, is it time to double down on Enphase Energy?
Wow, Enphase is such a disaster. If interest rates peak, then you want to own, honestly, I'd rather own KeyBank, I'd rather own USB. Enphase is an attenuated way to play the rates coming down, and I just think this stock is for sale. Tax law selling me to here in the end of the year. Good thought, but I think too aggressive. Sonny in Illinois. Sonny.
Hey, Jim, it's Sonny from Chicago, Illinois. A big booyah to you, my friend.
Oh, thank you. I got to get back to Chicago. I had a great time there last year this week. What's going on?
Hey, just want to say I'm an investment club member. I love what you do for us.
Thank you.
Yeah, and I've learned a lot from you, man. You've taught us not to panic when the bid is low, and you also taught us to pounce on stocks when they're cheap,
Sure.
And, you know what, Jim, I feel a little bad, man. I sold a lot of my positions last week, but I should have held on to them because I missed the rally.
Well, that's okay. That's okay. There's going to be many more rallies. What can I help you with? What stock?
Good. So, Jim, I wanted to get your thoughts on the retail industry. A stock I'm looking at has a 5% yield. They recently announced an acquisition. They got great luxury brands. What do you think about Tapestry?
Tapestry is dirt cheap, but I don't have a catalyst. Ralph Lauren's about to report, and my catalyst is I think they're going to report a very good quarter. I don't have anything that says to me you got to buy Tapestry right now other than it looks like value. How about Linda, my home state of New Jersey? Linda.
Hi, Cramer.
Hey, what's up, Linda?
Okay, thank you for taking my call.
Okay.
I watch your show with my father, Rocco, almost every night.
Oh, tell Rocco I said hi. Thank you.
Oh, I will. Okay. And my question is Exxon buying Pioneer? And if so, when and for how much?
Okay, they are buying it, and it's a complicated formula for arbitrage, but let's put it this way. You're going to get Exxon stock, and we sold Pioneer for our charitable trust because we didn't want anything to do with the arbitrage. We bought it for the gain, and now the gain is made. So I'm not as big into the merger as I am into the price that we got for the charitable trust. I think the fear of missing out will cause money managers to be less complacent about where they put their cash, and that's why I think you can wait for a pullback before you pull the trigger on any more moves yourself. But I think the right direction is that. On Mad Money tonight, Carvana's in the midst of a turnaround, so after earnings, how's it playing out? I'm learning about where the used car market stands and how the former market darling is faring with the company's top brass. Then Wall Street's been concerned about the staying power of travel in that travel bull market. So what can we deduce from the earnings reports of the two biggies, Expedia and Booking Holdings, when it comes to the health of the sector? I'm going to give you my take. And there's an AI unicorn waiting in the wings in the form of a company that everyone's talking about. It's called Databricks. So what can investors expect about the private company Databricks and when it might IPO? Let's check with the CEO. Then stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.